Hello, everybody, and welcome to the Dorsey Wright podcast. It is Wednesday, September 4th, and I'm Ian Saunders.
And I'm Eric McArdle.
And markets are back up again this morning. So far, what we're seeing here, the Dow's up just over 100 points. The major indexes seem to be up just shy of about 1% generally across the board. Kind of the opposite of what we saw yesterday morning. So one thing that we were taking a look at there, Eric, was some of the charts of these major indexes, right? We're seeing some interesting movement on those.
Yeah, absolutely. And I mean, there's been no shortage of activity over the past month, right? Mm-hmm. This has been a tough market environment for those who are inclined to check their portfolios on a daily basis. But when you look at the S&P 500 on the default chart on the Dorsey Wright platform, we do see some promising developments here. In recent trading sessions, we've been able to chart higher bottoms and recently higher tops. Most recently, we had a reversal up into X's today, facing overhead resistance at 2940, which has really been the defined level of resistance for the month of August. So, we'd like to see a move to 2950 to break out past that level. And when we look to the downside, now we've got a couple of support levels in between our lower bound support at 2830. So for those of you invested in domestic equities, in large cap equities, this has been a range that we've been bouncing back and forth between for the last month. And, Ian, I know you'd mentioned earlier you had a couple of statistics on that bounce. You want to share that with us?
Absolutely. So, when we're looking at the S&P 500, for example, a lot of the things that we kind of tend to look at in terms of measuring volatility is days that are going to be plus or minus 1%. Right? And we have a piece that we run pretty typically looking at that kind of update throughout the year, especially that was pretty prevalent there in the fourth quarter of last year. But we also have another area we can look at it for just the summer months, right? The summer months are typically going to be thought of as a lot less going on in the markets, although that might not have been the case this summer. Mm-hmm. But people out on vacation and whatnot, typically less going on. And we see that historically with a median summer volatility from plus or minus 1% in the S&P 500 is at about 14 days. Typically, right? And so we only saw one day that was plus or minus 1% for the month of July. But obviously that picked up quite a bit there during the month of August. There were 11 days where the S&P 500 either gained or lost 1%. And so that difference of 10-day difference is actually one of the most that we've seen in the past couple decades there, just between looking at July to August. But still, that brings us to the total summer, June, July, and August. We're only at 14 days there for 2019, which is the most that we've seen in the past several years. Hadn't seen that since 2015, which we were actually at 14 days then as well. But if we look back historically, again, at that median is 14 days. So while it felt much more volatile because of that drastic increase there for the month of August, if we look back historically at other summers in years past, going back to 1987, we're right in line with that median there. Mm-hmm. And interestingly enough as well, if we look kind of historically at just the returns during the June, July, and August, is typically at a median of 2.4%. And we were quite a bit above that there for this summer at 6.3% for the S&P. So even though we had the slight increase in volatility, the volatility was just about in line with what we've seen on the kind of a longer-term historical perspective. And we still had a pickup there in returns with higher than average returns.
Yeah, and I think your point regarding this not really being out of the norm from an annual basis, in terms of volatility, mm-hmm. right? We're pretty much in line with the average, so to speak. Now, obviously, things are a little bit heightened. You look at the VIX, reversing down today, reading about 18 on our charts on the Dorsey Wright system. So, a little bit higher than the average, which is around 15 and a half. And what this does is it creates a good opportunity for those of you who, say, are using covered calls in your business, right? This is something where, if you look at the implied momentum bell curve on the Dorsey Wright platform, you'll see now in the S&P 500 that the largest representation of groups within that overall index are in zone 3. You've also got a large basket in zone 4 as well. So these are areas where you can look to perhaps sell a covered call on top of an existing position, generate a little bit of extra premium given the volatility, which helps for income, but also can act as a hedge if you are concerned with increased volatility moving forward. And hopefully we won't have any of that, but it's always good to have a game plan instead of a hope, right?
Absolutely. And we've looked at some pieces. I think we had in last Thursday's report that September is historically the worst month for at least domestic equity markets there. So, I mean, looking at that now, we're in the month of September. I mean, market was down yesterday, up today. We'll see how that plays out throughout the rest of the year. But when we're looking at things, I guess, to look forward to as we close out the last 4 months of the year here, there are some indicators that we've been watching there. And one of the ones we saw the BP NDX, the bullish percent for the NASDAQ 100, reverse back up into X's last week. So that's going to be move a little more quickly than some of your other major market bullish percents like the NYSE or the OTC there. But that did reverse back up at a chart level of 54 and didn't lose too much yesterday. It was at 53.92, but even with yesterday's downwards movement. And the next one that we were looking at as well was the bullish percent for the S&P 500. So that moves a little bit slower than the NASDAQ 100 bullish percent, but still that was now, even with the intraday reading, we were just over 1% away from a reversal back up in X's. So that would be a further kind of further confirmation or more on the positive side of things, at least for the domestic equity picture when we're looking at positive indicators moving forward.
Yeah, and when you're looking at that on the Dorsey Wright platform under security selection, or rather asset allocation, technical indicator report, and then indices, this is a topic we've covered at length, but the large cap indices holding up better in terms of their field position, right? As you mentioned, NDX sitting at right around midfield, S&P 500 sitting right around midfield, whereas you've got the mid and the small caps, kind of in the middle to lower end of midfield, right? So they're trailing those large cap indices by a decent margin, and that's something that we've seen, displayed on other indicators as well from a relative strength basis. So, large cap holding up well, all things considered, relative to smaller counterparts.
Absolutely. And one of the other indicators that I did want to make sure that we mention here as well, we're looking at things from a broader perspective, not necessarily just the cap-weighted indices there. The 10-week for the New York Stock Exchange is one that we tend to follow pretty frequently there in terms of more near-term indicator. So it's looking at the percentage of securities in the New York Stock Exchange that are above their 50-day moving average, right? So that is closer to kind of moving higher as well there. That reversed actually back up. Is in a column of X's above the 30% level, which is a point we tend to watch out for kind of positive confirmation. And then one that is getting closer to switching is the World, the 10-week for World, which is within 1% of reversing back up into X's. So that's looking at not only domestic equity side of things, but international areas as well, which while domestic equities would probably be doing a little bit better here recently, we have seen a few changes there in the international front, haven't we?
We have, and one thing to note before we switch over is both of those reversals, the one on NYSE and the one that's poised to take place on World, coming from below that 30% threshold. So that's typically a good sign, a good time to be offensive and aggressive in that allocation. But when we do pivot over to the international space, there's been a pretty wide dispersion, as there always is, among international markets, right? We're seeing, developed hold up relatively better than emerging on the year, up about 7 1/3%, compared to EEM, for example, looking at 2.25% on the year. And so you still haven't seen, as you mentioned, prior to us recording, you haven't seen developed move back to a buy signal on a relative strength chart yet, but certainly showing some improvement in the near and intermediate term. And when you look at different areas in the international equity space, I think there's always a good time to be looking at indicators, looking at ways to find high RS ideas within, whether you're looking at developed or emerging markets. And one of the ways we can do that is with the models, right?
Exactly.
So we've got a couple of international models, and I'm going to pivot over to you because I know that you've got a lot of experience on that front. Anything worth noting? Any recent developments that we've seen that may be worth sharing with our listeners?
Absolutely. So we actually saw a quite recent development this morning. There's a trade in the First Trust International model. So that model is going to be similar to it's like the Focus 5 of international, right? Instead of looking at sector rotation, it's looking at country rotation. So we have country funds from First Trust in there that will rotate the model. We'll hold 5 of them at any given time until it falls out of favor against its peers, and then we'll pivot to the next highest ranked fund or country there. And we saw the model actually move out of developed markets, move out of FDT this morning and move into FLN. So FDT is that First Trust Developed Markets Fund, and then FLN is going to be the First Trust Latin America Fund that we have there. And so when we're looking at it again, you mentioned there that the comparing developed markets against emerging markets on a relative strength basis has shown some near-term favor for developed, but it did not move to that longer term, did not move to that buy signal. And if you're looking at, say, EFA against EEM, it still was sitting there at that double top and did not break out there. So when we're seeing this the near-term, positive signs, at least from the emerging markets and specifically with Latin America, if you look at those on a relative strength basis kind of across emerging markets, then we're seeing Latin America has been a little bit showing some more near-term momentum here. If you compare the relative strength charts of, let's say, the ILF against EEM, that chart is going to be on a buy signal there. If you look specifically down at Brazil with EWZ against EEM, you get a couple consecutive buy signals there. And so that's a little bit different than looking at, let's say, other emerging markets area like China, which are going to be showing a little bit more deterioration here recently. Fund scores are going to be a little bit more negative there, so we're a little bit lower there as well. And those charts are going to be right on down towards the bottom of those, the bottom of their trading bands, and should definitely show some more sell-offs.
Sure, and you mentioned China. And when you look at, say, the iShares China ETF FXI, it's got a fund score of 0.46 on our system, so about as bad as it gets, right? And going back to why you want to use RS investing in the international space, if you bought a broad market product like EEM, right, you're going to have over 30% of your holdings in China. So, that's the majority piece in that index by a wide margin. And as a result, you'd be lagging significantly relative to a high momentum strategy or high RS strategy that you can employ, such as the First Trust model or any of the other international models that we have on the site. So, definitely a place to avoid. And international investing, as mentioned, can be treacherous at times and move pretty quickly. So, it's always good to have a process in place for that.
Absolutely. So with that, I think we've hit on most of what we were looking to cover here, at least this morning. Given that the September is typically that worst month, a lot of increase in volatility, we'll continue to update in the report and the videos and definitely on the podcast here as well as we head down this 9th month of the year here.
Yep, absolutely. So we look forward to keeping you all updated, and we'll talk to you next week.